Are you overinvested in tech? Well, I started thinking about this. QDVO versus KQQQ, optimizing the high yield tech ETF exposure. If you carry QDVO and KQQQ all in the same portfolio, are you overinvested in tech? Hey everyone, welcome back to the channel. I'm Doug, the retirement guy. No one wants to have overexposure in AI and tech. Because of the valuations are extremely high right now, you want to make sure you're not really exposed heavily into either one of these sectors. But I'm looking to optimize the exposure that I do have. And this actually came from a couple of comments I got from the YouTube channel, a couple of Patreon ones. And I started looking at myself. As you know, I'm reevaluating my entire 2026 portfolio and see what changes I need to make and any improvements I can do and so on. And two funds popped up on my screen, QDVO and KQQQ. And I started asking, are these both identical to each other? Are they both doing the same thing? Are we getting the same results? Do we need both? Should we combine? So there's a lot of questions I threw out there, and we've had some people ask the same thing. But here's the thing, both of those funds have outbeat the NASDAQ 100 for total returns. Now, that's hard to do for an income fund, of course. So I'm going to compare these two funds to see, do we have overlaps? Do we need to replace them? And make a decision about this for my 2026 portfolio and for you. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. I am not a financial advisor. This whole video is designed for educational and informational purposes only. And if you need financial advice, always contact a financial advisor or a professional to make those decisions. So now we take a look at the investments. The QDVO from Amplified CWP Growth and Income ETF has about a 9.7% trailing yield. It's a more balanced income and price appreciation type fund. And the other one is KQQQ, the Curve Technology Titan Select ETF. Has a little bit higher current yield, around 12%. So it gives you a higher income with tax efficiency. So we do have a little difference, a little more income, handling taxes a little bit better, but then we have a nice balanced fund with the QDVO. The sectors that they deal with is high tech valuations that create that risk and that overexposure. So they're heavily in that tech group. We need to optimize the exposure with a balanced risk. So QDVO and KQQQ have outpaced the NASDAQ 100 in total returns. And the key distinctive features that they have is they're both actively managed with option strategies. They're focused on the tech sectors and income generating. And they have a different portfolio construction approach. So these funds offer a way to optimize your tech exposure while generating substantial income potential. When we take a look at the income machine, the income generating part of this, we can look at this. QDVO, I continue to say, it's about 9.91%. Now, the trailing 12-month yield is at 9.91, but in recent distributions, we've seen it go up to 10.9%. Now, we're just using the snapshot of the information available as doing of this video. So distributions, are showing an upward trend with the portfolio value continuously growing. You can look at QDVO's dividends. You can see from November 24th to all the way to November 25, 1 year difference. Look at the change in the value of their distributions. So they've gone from about just a hair over 15 cents to 27 cents. Now, KQQQ income evaluation hits about 12%. It started with a conservative 15-cent monthly distribution. It grew to a stable 40-cent range as the fund matured. So the current yield today is about 12%, slightly below the targeted range of 15 to 16% that the managers are expecting to get from the fund. So it's telling me that there's still fruit on the tree that they can try to continue to improve on. Now, these numbers will all change. There's no question about it. These numbers will change every time they pay out a distribution or make changes to the fund. But across the board, okay, I'm going to lean a little bit more towards the KQQ right now because of that extra, about 2% additional yield on the fund. Now, the portfolio construction, the QDVO approach, it holds just under 50 stocks, less than the NASDAQ 100. It includes non-NASDAQ names like Visa and Eli Lilly. So this is where they get that more balanced approach with a wider diversification. They do have 45% of their fund in technology. They have 14% into communication services, 13% into consumer cyclical, but then they started into the healthcare and the financial services at 7%. Now, my research, what I've been able to see and do is, again, I see the healthcare starting to become a major factor and another sector that's starting to grow. While KQQ's approach is really more concentrated, it has 15 to 25 stocks in its core portfolio. It uses more synthetic price for the positions, and it holds cash and treasuries to give you more options available. Now, their tech is a little bit higher, 48.03%, but they're still communication services and they're still in the consumer cyclical. So they haven't really dived deeper much into the healthcare financial services after that point. So you can see KQQ is definitely more focused on tech and on income generation as their primary goal, while QDVO is kind of diversified a little bit, pulling away from the heavy non-tech exposure to opening the door up to other sectors out there. When I break down the sector allocation, on the right is KQQQ, and you can see technology, just pretty much what we talked about. And then you can see with QDVO that they have a lot more pieces of their pie. They do have the main core, so they are tech, but they do have an opening and growing segments of all different areas of healthcare, financials, and so on. When you look at the stocks down below, they are covering both similar to each other. I was shocked that KQQQ, the NVIDIA was not in their top 8, but then again, their treasury bills have really taken over a major chunk of theirs because they're waiting for changes in the marketplace. The option trading strategies. Now again, QDVO uses a balanced trading platform. They use a technical covered call writing on individual stocks. Their primary focus is on capital appreciation, and second is on high income. When I look at KQQ, the strategy is more focused on generating higher income and using synthetic price to use for some positions. And it uses protective puts to reduce the downside. So there's some big differences between the two. Is QDVO is trying to give you that balanced approach because they want to keep their capital appreciation, while KQQ wants the income, but they're going to protect your downside side of it. So again, we're moving towards, do you need income? KQQ is probably our way to be. And if you want a balanced approach, QDVO is very, very equal to each other. But here was the one thing I did find. Following the April 25th market correction, when we had all the tariffs announced and so on, KQQQ modified its option strategy. It adjusted the price sensitivity of its synthetic options from 1 to slightly more than 1, while its covered call strategies reduced the price's sensitivity back to a net exposure of 1. So this aims to provide more room for appreciation. So when the April tariffs all kicked in, you saw across the board markets drop dramatically. KQQ already started to switch to say we're going for price of valuation. We're going to try to get some more valuation out of our fund. And that was the thing that got me, is these guys are watching this and they're able to make adjustments very quickly when they see market trends change. When I look at the total returns, and like I've said on this channel so many times, I don't really care about the yield. I don't care about the growth or the NAV. The first number I always look at when I do any evaluation, when I do any study, is total returns. And when I started looking at this, I said, wow, QDVO has a 1% increase in their total return over KQQ. Is that price evaluation? Is that, is that keeping the value of the fund stronger and growing? But when we get down to it, we have a 1% difference between the two. So they're very mirroring each other. They're very close to each other. So when I look at that, total returns, I like both funds right off the bat. Now we get into KQQQ giving more income, QDVO giving you more appreciation of the value of the fund. Now I start diving deeper. That's when the other ones start to become concerning. I don't not focus on them, but that's secondary and third when I look at it. So the KQQ's modified option strategy in April was the correction. It was done right. The price adjustments from that 1.1 to slightly over 1 gave them that price sensitivity and for more room for appreciation. So I'll say we've seen that. We look at the charts, we see that part of it. So the post-tariff or the sell-off KQQ is stronger total performance. QDVO showed initial lag but caught up, and it narrowed that gap between the two. And distributions are only about 2.2% difference. So realistically, even though 1% better on QDVO, but the gap between the two is about a 2% difference when you get to your yield. We look at the comparisons now. We look at the expense ratios. QDVO 0.55, KQQQ 0.92. So there's a difference. QDVO has an advantage of the expenses, which means more of your money will go to work into the fund in QDVO. Now, tax efficiencies. Now, I don't know where you're putting your money. This is a thing that I always say, you always talk to an expert on. I'm not an expert in this. I personally have a CPA. I can pick up the phone and call tomorrow and get helpful tips of what's going on. But the KQQQ tax efficiency, over 85% of their distributions were recorded as return of capital. Now, we know that's going to sound bad and it's going to look bad, but it's the whole thing of the way they operate their tax efficiencies. They're kicking the can down the road. They're creating it into capital gains and saves us taxes later on. It's more tax efficient distributions. Now, QDVO tax treatment, only 10% of their total return of their part came back as return of capital. So ordinary income distribution. So you're going to pay, if you have this in a standard fund, you're going to pay more taxes on the QDVO disbursements than you will on KQQ. If you put it in an IRA, if you have it a 401k, if you have it a Roth fund, now you're dealing with taxes in a different handle. That's why I always say, talk to an expert on that point. So when we look at the fund now in the comparison, when we have QDVO and KQQ both in that tech focused side of it, the yields 9.7 to 12%, balance versus income focused. We look at other ones out there, JEPQ, the QQEI. Both have high yields. They both have the market base. They're both indexed, but these two really pop to the top of the list when we have things that we're looking at the NASDAQ 100 with the tech drive. The outperformance of the NASDAQ 100 base income funds, the higher yields compared to traditional tech, and more diversified approach. So the key considerations, both funds employ active management. KQQ has that better tax efficiency and a higher return of capital and a little higher income from the yield. QDVO offers that lower fees, has a little higher total return, and a balanced fund across the board. So when I kind of come to the final conclusion of the whole package, I think both funds are diversified exposure to the tech sector income. I really like the both funds. I like the balance of QDVO. I like the income focus of KQQQ. I like the diversified exposure in the different market cycles. So for me personally, I'm keeping both of them into my fund. I think QDVO in a bull market may excel with the higher appreciation potential. And in the bear market, I think KQQQ may show a better resilience with the high yield. So I'm keeping them both in my portfolio. I don't think we have a clear winner loser. I don't think we have a clear winner, take all. I think we have two funds doing very, very well across the board. And when I really delve into the whole market of what they're investing in, I kind of see these guys as brother sister. I see them both going after the same thing, both doing great performances, but both going down two different paths. So I'm comfortable keeping them in my system, keeping them in my portfolio. What do you think? Tell me what you think about this. Do you think you should have one or the other, or keep both in the funds and let them roll? Let me know in your comments below. I'd love to hear from you.